Good day, ladies and gentlemen. Welcome to Standard Bank webinar hosted by SBFC, Standard Bank Financial Consultancy. My name is Ketwe Gunene. I'm the coordinator. And today we're looking at understanding the true value of life assurance. We've got three panelists that are going to take us through this presentation. Before I tell you their names and give you a small intro, let's just do some housekeeping. Hopefully you're comfortable where you are. This is going to be about 45 minutes to an hour. Any questions can be typed in the small questions box on the side. Okay, so let me tell you about our three panelists. First one is our resident DJ, Mr. Errol Meyer. He's a certified financial planner and an accredited advocate of the High Court SA. He holds qualifications in finance, law, teaching, and taxation. He's authored a book called Notes on Estates and Financial Plans, and he is currently our advisory propositions legal specialist here at Standard Bank. That's why we always have him in the room. Then we have Ms. Faeeza Khan. She's a senior legal specialist at Liberty. She has an LLB degree as well as her master's degree and is an admitted attorney. Faaeza has also completed a postgraduate diploma in certified financial planning and is passionate about the financial planning industry. She has been in the industry as a legal advisor for 7 years. Then finally, but definitely not least, we've got Neil Burtis. He's a senior specialist on risk products for the Liberty Group. He holds a B.Ed and a B.Ed honors from the University of Northwest and a postgrad diploma from the University of Free State. He has 11 years experience in the financial industry, and as a senior specialist, he works to discover new business opportunities through segmentation, client book analysis, as well as client and advisory education. So that's our three panelists today. My job is done, the hardest part. So I'm going to hand over to them now to take over for you. Good afternoon.
Thanks, Ketiwe. Well, good day, attendees. Welcome to our webinar. We will be covering some important aspects of financial planning. In particular, we will be discussing the risk that we encounter in our journey through life. A special welcome to Faaeza and Neil, and thank you for joining us today. So we will start with Faaeza and thereafter Neil to give us a short introduction. After Neil, we will have a panel discussion, and I have prepared some questions for the panel. And with that, over to you, Faaeza.
Hi, Errol. Hi, everybody, and thank you so much for having me here today to chat to you about financial planning. What I want to have a look at today is financial planning holistically that applies to each and every one of us, but also maybe have take a deeper look at financial planning and how it affects us women. So when we look at financial planning for women in particular, there are certain obstacles that we face on a day-to-day basis and in our lives. So I want to look at 4 different obstacles that we face, the first one being the gender pay gap. So if we look at the gender pay gap in South Africa, you will notice that women earn about 28% less than their male counterpart, which leaves us with about 28% less to do our financial planning with. And this is a male counterpart doing the same work as the lady does. So about 2 years ago, that gender pay gap was down to about 10%. And within a 2-year period, it increased to 28%. Reason being that women are less likely to negotiate around the boardroom for greater increases, or perhaps when they join a new job, they're more reluctant to enter into those negotiations. So I think, one of the solutions would be for us women to be a bit more forthcoming about what our needs are and not to be shy to enter into those negotiations. And perhaps also just have a little confidence in your worth and the value that you're going to be adding to a business. The other obstacle that women face nowadays is divorce. So how does divorce affect financial planning? Well, if you think about it, and from a statistical perspective, at least 40% of marriages end in divorce before the 10th year wedding anniversary. And the average age of a woman at that time is around 40 years old. So from a financial planning perspective, if you did not cater for your retirement planning, for example, because you had an expectation that your husband would be saving on behalf of the both of you for retirement, then you are left with 25 years to save for retirement if you retire at age 65, which is not a very long time when it comes to retirement savings. The rule of thumb is that we need to start saving from our very first paycheck, and that is to cater for our many years through retirement. And I think that leads us to the third obstacle, which is life expectancy. Women live on average 6 years longer than men. That means that we need at least enough retirement savings for a further 6 years. So we've got to start saving as early as possible because we live longer than men, so we need to save more, but we still have to contend with the gender pay gap because we earn less than men. So you can see that all of these obstacles kind of play a massive role when it comes to financial planning specifically for women. The last thing that I want to maybe just touch on is the amount of single mothers in South Africa. So of all the moms in South Africa, at least 50% of them are single moms, and only 16% of which receive financial support from the child's father. So you have women out there that earn at least 28% less than their male counterpart. And if there are mothers, at least 50% of them are single mothers, and only 16% of them receive financial support from the child's father. And of the 50% single moms, also 33% of them are supporting their parents. So you can see that it's just really a knock-on effect. And it might look like doom and gloom and that there's no way out of this type of situation, but it is a reality for many women, and we can't really sit back and not do anything about it. We've got to look at financial planning, and we've got to look at any opportunity that might be there to start putting a plan in place so that we can do something about our financial reality. So when it comes to financial planning, and not just financial planning for women, but financial planning for everybody, there are specific financial needs that we all need depending on the stage of life that we are in. And there are many stages through this journey of life that we have. One of the stages that I want to start with is called the Young Achievers stage. And with the Young Achievers stage, your financial planning priority is earning an income. So you might be in a position where you are establishing your career and your needs are perhaps to settle any study loans that you might have. Maybe you want to build wealth, buy assets. And so we need to look at what types of risks we need to manage when it comes to the young achiever. And one of the risks that we need to perhaps look at is, how do we protect your income as a young achiever? So when you are looking at your financial plan for the young achiever, income protection is a priority. The young achiever's financial plan looks different to the young parent's financial plan, because with the young parent, you need to provide a home that is safe and financially secure for your family. And so the risks there change because your priority has changed. And so the type of risk management that you need to look at is not only income protection, because you still need to protect your income to cater for your dependents should something happen to you, but you also need to look at death as an eventuality, and to ensure that your family can continue in the event of you passing away. So in this situation, life cover becomes pertinent. Disability cover and dread disease cover is also very important. So you need to look at, well, should I become disabled or get a dreaded disease? How is my income going to be protected? And what else would I want to achieve under those circumstances? So perhaps, you know, getting rid of any debt that you might have becomes a priority. And so you'd look at different products depending on your situation and your need and your intention. We then move through life and we become established providers. So that is the next life stage that I'd like to chat about. So when you are an established provider, perhaps your children are, you know, all grown up and they are financially independent of you. And so taking care of your family's needs from a capital risk perspective might be reduced. So you might have to re-look at your risk cover and maybe reduce your life cover. You might also want to look at retirement because that could be a worry for you. And you might want to move money that you've been spending on larger risk policies. You might want to move that into your retirement savings, or at least a portion of that into your retirement savings. Perhaps look at supplementing your retirement savings. You might have a pension fund or a provident fund at work. You might want to capitalize on your tax deduction by contributing into a retirement annuity product to supplement that retirement savings. So the established provider, we kind of focus on the retirement aspect because the established provider is nearing retirement. The last life stage that I'd like to look at is the empty nester. So what does the empty nester focus on? So the empty nester, the reason why we call it the empty nester is because the chicks have fled from the nest. You know, the kids have now all probably left home. They have qualified in their degrees. They, you know, their financial dependence on their parents are slim to none. And the empty nester needs to, is probably already in retirement, and we need to ensure that the retirement savings that he has or that she has can last for as long as the planner lives. So the risks that we need to manage is possibly investment risks, healthcare needs, and also estate liquidity and estate planning. But from an estate planning perspective, we don't only look at estate planning for empty nesters. We look at estate planning for every single person, from the young achiever, the young parent, the established provider, and the empty nester. Everybody needs an estate planning solution so that their intention in terms of their wills can be carried out in the event of death. And that is really what the financial planning circle looks like when it comes to your different life stages. So as a woman or as an individual, how do you get this financial plan on track? What do you need to do? So the first thing you need to do is you need to find a financial planning partner. And a financial planning partner is really the financial advisor that you choose to walk through this financial planning journey with you. You've got to choose the right person, someone that you are comfortable with, someone that understands you, someone that you can relate to, and someone that is going to put your financial planning goals into motion. It's someone that will help you set your financial planning objectives and will help you figure out and decide how to prioritize these financial planning objectives. You can't, or you don't really have to put all of your financial plans in place at the same time. You can do it piecemeal. You can start with a specific financial planning objective and move to the next depending on what your priorities are. And your financial planner is the person that is going to help you prioritize and get the ball rolling. They're going to help you get into the game. They're also going to help you review your financial plan on an annual basis, or if your circumstances change. For example, you move into a home that you bought, your circumstances have changed. If you have a baby, or if you get married, or if you retire, if you get divorced, those are different circumstances that change, that need the input of your financial advisor. So this financial planning journey that you embark on is a lifelong process that you kind of have to stick to. In order to stick to your plan, you have to exercise discipline, and you have to involve your financial planner every step of the way. So the different aspects of financial planning that you would have to consider is budgeting. So how are you going to spend money to make sure that your financial goals become a reality? You also have to look at investment planning, perhaps. So, and that depends on the different types of goals that you might have. Are they short-term goals, long-term goals, retirement goals? Are you looking at having an emergency fund in the event of something happening that is unforeseen, that might require money that needs to be readily available? So those are the different investment conversations that you will have with your financial planner. Retirement planning always needs to be a topic of discussion, because we need to make sure that at any point we are able to retire when we stop working. The last time I looked at the statistics, and this was about 2 or 3 years ago, only 94% of South Africans could retire comfortably. You know, that is quite alarming, and we need to make sure that we're part of the 94%. And that would mean that we need to start as soon as we start earning an income. We have to start saving. The other aspect of financial planning is risk planning. And risk planning is all based on your life stages and what your needs are. So intention is always paramount when it comes to financial planning and what you want to achieve as an individual. Estate planning, like I mentioned prior to this slide, is something that we have to look at from the very beginning. You don't only look at estate planning when you are older. You look at estate planning as soon as you possibly can. And you have a will drafted, and when your circumstances change, then that will needs to be updated. And you also need to let people know where your original will is, so that that will is collected should something happen to you, and that is the will that's submitted to the Master of the High Court for your estate to be wound up. So know where your will is, make sure that it's a valid will, make sure that it's an original will, and cater for your estate planning throughout your financial planning process, and update your will when your circumstances change.
Thank you, Faeeza. Again, I'll move over to Neil.
Thank you, Errol. Good afternoon, everybody. So as Faeeza explained to us, that even though we find ourselves in different stages of life, we all face the same risks. So we all face the risk of dying, of becoming disabled and not being able to earn an income. And we all face the risk of being diagnosed with a dread disease. So as we move through the different life stages, we all still face the same risks. So if I can look at a young achiever, it is very, very important that a young achiever will be able to earn an income throughout his or her entire life. So that is why we really need to look at a form of income protection for our young achievers. Not that it's any less important for any other person in one of the other segments, but because the youngster is only starting out now, they really need to make sure that they won't become, and I'm going to use the word, a burden on society. They need to be able to earn an income, and also in that instance be able to be self-sufficient. When we look at this slide, I want you to focus on the right-hand side, where it says claims gender split. And you'll see that we have 69% of claims paid last year for our male clients, and only 31% of our claims paid for our lady clients. Now, this is not because men are more sickly or more prone to become sick or disabled or die. It is merely the fact that we have way more male clients than female clients. And like I said, that is very alarming. We need to start and we need to focus on our lady clients as well. If I can use an example as the humble housewife, it is no less more important for her to have cover than a male counterpart or a husband. If we look at if something should happen to the wife, who will go and fetch the children from school? Who will assist with homework, the cleaning, the cooking, the running around between sporting events? Will her husband or male counterpart be able to take off from work to fulfill all those duties? Or will he have to get somebody in to help him with all of that? And will there be enough money to do so? So we need to look at our lady clients as well when we do financial planning. And for the ladies listening, please go and speak to a financial advisor or planner or broker to help you with this. When we look at the types of claims that we had, we see that cancer and cardiovascular disorders made up the two top parts or the two biggest portions of the claims paid. And we see year on year that those two percentages or those two claims become higher and higher and higher. And that is mainly due or largely contributed to by our lifestyle that we live, our modern lifestyle. And that is something that we really need to focus on as well, as there is no discrimination between gender or age. We see younger and younger clients being diagnosed with cancer, and then younger and younger clients suffering from some other cardiovascular disorder. When we look at our male clients specifically, there you'll see that the cardiovascular disorders and the cancer claims make up more than 50% of all the claims paid out to men. And again, this is not only our older clients or the empty nesters. This is straight through all our male clients. When we look at the top 5 causes of men's cancer conditions, we'll see that right on top there is prostate cancer. And then if we look at the top 5 causes of men's cardiovascular diseases, we have coronary artery diseases. And as I explained, cancer and cardiovascular conditions do not discriminate between genders. When we look at our lady clients, the top 2 is also cardiovascular conditions and then also cancers, with breast cancer being the number 1 cancer claim and also coronary artery diseases being the top cardiovascular claim there. And it's also that what we have seen is that it is really younger and younger clients that are diagnosed with breast cancer. We have claims from 19, 20-year-old clients that have been diagnosed. So it really is something that we need to start talking about. Faaeza explained the importance of having a financial advisor that you can trust. And if we look at the non-disclosure fraud claims, so that is where it comes in, where you really need to trust your financial advisor or planner. You need to be able to tell him or her every little detail about your health and about your family's health history, to make sure that when there is a claim that we can help you and assist in paying that claim. We really, really want to see you being helped when there is a claim. So if you do not trust your advisor to tell them about any other conditions that you are not comfortable discussing, then maybe it is time to go and look for somebody that you are comfortable talking to. If it means that you need to have a gender match, then please do so. And then just as important, where it says the 4.7% does not meet criteria, it is very important that you understand what benefits you have and how they will help you in an event of a claim. Not so that there's any disappointment when strategies really strikes and you need that claim to be paid. Errol, that's my portion. Thank you so much.
Thank you, Neil. Thank you, Faeeza. Well, as said, we'll have a panel discussion, but I want to pick up on something that you mentioned, which was quite interesting.
Yeah.
And that is that only 6% of people can actually retire. And sometimes I wonder, and you said it was quite a while ago, but sometimes I wonder if that amount is actually relevant to South Africa and if it's not less. So I've been thinking about that.
Yeah, and that's why I wanted to make sure that, that I didn't disclose that stat as at today, because that was a few years ago. We are also struggling from an economic perspective, so I would not be surprised if that stat is worse. people in South Africa are struggling to retire, and they're struggling to retire comfortably. And that basically means that they cannot afford their needs.
And that raises the question, what is it that one can do? Well, first of all, get a financial planner to guide you through all these options. You know that they say that longevity is one of the greatest gifts, but also one of the greatest risks, and especially where we're now in South Africa. So perhaps one should start thinking out of the box, and if you cannot retire, don't, maybe a rewire. So people should think about learning other skills and postponing retirement, and our legislation is moving that way. And I think these are the type of things that one should discuss with a financial advisor. But let me move on. Something that you also mentioned right towards the end, you touched on certain aspects of financial planning, such as investment planning, retirement planning, etc. You mentioned that budgeting involves spending wisely. What did you mean by wisely? And can it be said that preparing a budget is the starting point when preparing a financial plan?
So, budget is important to implement your financial plan, but it is not the start of your financial plan. So it's just one of the considerations that we need to take into account. And the reason why I brought it up, and spending wisely in particular, is because you've got to prioritize what is important for you. And it can't be an instant gratification type of expense. It must be an expense that is going to assist you in the long term, and especially when it comes to ensuring that your financial dreams become a reality, that you are able to retire securely, that you are able to take care of your family should something happen to you, should you pass away, should you become disabled, that your family is not going to lose their home if you get a dreaded disease. So you've got to prioritize, is the DSTV the most important thing, or is your life cover policy the most important thing? And that is what I meant by spending wisely and budgeting effectively.
Yeah, I guess, and that leaves some room to have the discussion. You get some good debt and bad debt.
Correct.
And you're trying to get rid of the bad debt. A good debt could be investing into your bond in your house. Excellent. So, but let's make use of an example. Say that you've done a financial plan for me, and your analysis shows me that I will need life cover since I'm the breadwinner and I have 2 young children. How would I go about to calculate the amount? And some indication, maybe Neil, you can help us here. What will it cost me? So how would I go about to do this calculation? How much do I need? Just the ballpark figure.
I think that it's important to kind of figure out, well, what does my family need on an annual basis, and how much would they need that amount for? So if you look at a family that might need 250,000 Rand a year, and they might only need that for 4 years, then you can estimate that the amount of cover that would be effective is perhaps R1 million, and that it escalates with CPI so that your benefit at least grows accordingly. And hopefully when you do pass away, it's still worth R1 million. From a quotation perspective, Neil, what do you think?
Well, we have to look at the individual, because we're managing different risks, like I said, over different life stages. But if we can take an average of, let's say, a male, 40 years old, a healthy life, for around about R1 million life cover, we can look at maybe 300-400 Rand a month. Also, that we just need to keep in mind is that the younger you are, the more affordable or the cheaper life cover is. So that's also why spending responsibly is also very important.
Yeah, and that ties in with the budgeting. What is important? What is priority? This is where you need a financial advisor to guide you. Once you know more or less what it's going to cost and what is the impact and the value, then you're in a better position to make an informed decision. Okay, well, I can't leave the taxman out of this. Now, I need to know, if I would take out, let's say, life cover of 2 million, I'm an individual, like I'm a scenario above, and I don't want to share that. I want to make sure I get 2 million. How much must I pay the taxman?
Well, every single life insurance policy on the life of a person will attract a state duty, and that is at 20%. So you would need to increase the policy proceeds to cater for that 20% that you need to pay to SARS.
And well, that's from a state duty point of view. And other taxes like income tax, capital gains tax?
Yeah, Errol, there's no income tax or capital gain tax on a pure risk policy. It's a capital amount, so we don't have to really worry about those taxes. It's really just a state duty that we need to look at, which is a tax that arises upon your death.
And that's only after the estate would be 3.5 million, and in some instances 7 million.
Yes, you're
that
absolutely
you need to worry about that.
Yeah.
Okay, well, let's have a look at that cash flows now. Let's say, for example, I take out a policy in my life for 5 million rand, and I need to know who will that money get paid out to in the event of my death. If it's paid, for example, into my estate, my spouse will not be able to access it, and I have to wait for the estate to be wound up. Now that creates a cash flow predicament. How do I solve for that problem?
So what you need to look at when you're nominating beneficiaries on a life insurance policy, the question you must ask yourself is who needs the money? And when you answer that question, that is how you need to allocate beneficiaries. So for example, if you have a life insurance policy, like you say, Errol, for 5 million rand, and well, you think, well, there's two different people, for lack of a better word, that's going to need the money. The one is my spouse and the other one is my estate. So if, for example, your spouse needs 50,000 rand a month, and the estate is possibly going to take 20 months to wind up, then you know that at least 1 million rand of the 5 million rand needs to be payable directly to your spouse so that she's not dependent on the estate to receive an income. So you would then allocate a 20% beneficiary nomination to your spouse and 80% to your estate so that your executor can settle your debt and pay any taxes that might be applicable at that point.
Yeah, interesting. I find in practice this is where things often goes awfully wrong. That quite often the client will be advised to nominate the spouse as a beneficiary simply because there's no executive fees. But then you land up in a situation where there's no funds in the estate, and somehow she's got that money, maybe she's invested it, and she's got to pay it back into the estate, or maybe go and borrow some funds in order, because there's still a bond to be paid and she's going to be the beneficiary of the house. So that beneficiary nomination that you're talking about, receiving that proceeds, and cash flow and financial planning actually goes hand in hand.
Absolutely.
Would you agree with that?
Yeah, you've got to make sure that your intention is carried out. You don't nominate beneficiaries based on tax or expense savings. You nominate beneficiaries based on your intention.
Yeah, that makes sense. Neil, from your side, tell me, what does it mean to insure against the risk of disability, or stated differently, what is disability and why do I need cover like that?
So Errol, in essence, we cover against disability because when you are disabled, we need to replace your income. So when we talk disability, it's directly linked to your ability to earn an income. So we need to ensure that you will still earn an income when you cannot work for a certain period of time, or whether it be for a couple of months or for the remainder of your life.
Okay, so I would get cover to protect me against the loss of income, but surely I want to protect myself because maybe if I'm disabled, I need a lift in the house or a special car. How would one provide for that?
Exactly. So that's why we can't, well, it depends on the client's needs, but ideally we would want to look at disability cover and rare disease or critical illness, or even trauma, so different names for critical illness, cover at the same time. Because the disability cover will replace an income, and the critical illness portion will help you to make the adjustments to your house or your lifestyle where it's needed, to either, like you said, put in a ramp, a special bed, a caretaker, a special car, something in that line.
So there are different solutions for different risks. Now, let us say I have a family history of heart attacks, and I'm worried that I may fall prone to say, why would I want money for suffering a heart attack if I have a good medical aid?
Errol, the reality is that our doctors don't have to charge medical aid rates. In instances, they charge much more. From personal experience, I know that medical aids do not always cover all the costs. So you need to have, or you would want to ideally have money to pay the shortfall in medical bills. There's instances where medical aid won't cover certain procedures, especially when we look at cancer. So then that would have to be out of pocket. Some of those costs can run up to 30,000 Rand a week, and you would ideally want to have that money to give your loved ones or yourself the best possible treatment that is out there.
Okay, so let's talk a bit about the insurance contract. The contract that the client will enter into with the product provider. Now, surely the insurer will insist on some medical test to make sure that they can provide me with that particular cover. So let us say I'm not truthful about disclosing some health issues, maybe because I purely forgot to mention. Will that cover still pay out?
Errol, unfortunately, not in all instances. We need to look at how we manage our risk. If you suffer a higher risk of having a heart attack or contracting cancer, we need to adjust your premium in accordance with that risk. If you have perhaps forgotten to tell us about a certain condition and we find it to be material to your policy, we will have to look at the end in reconstructing the policy to see if we will still be able to pay out that claim, given that we had all the information right from the start.
So what you're saying, if it's material, you run the risk that the life cover will not be paid out. But if it's not that material, there could be some adjustment.
Exactly. Like, for example, if you put 51 Toscana clothes instead of 52, that is not material. But if you forget to tell us that you had cancer within the last year, that would be material.
Okay, something else. Is it possible to have two lives assured on one policy? Say, for instance, I want to ensure that my outstanding bond on my house is settled upon the death of either myself or my spouse, whoever dies first. Will such a strategy make sense? And what are the advantages and disadvantages of such a strategy?
Absolutely, you can do that. A lot of clients opt to have that, but what we need to look at is, Faeeza, and you yourself spoke a lot about the estates and winding up an estate. When there is a claim, there could be additional taxes for one of the spouses, especially when we look at income disability claims. Because remember that disability replaces an income, so that money can be seen as an income by SARS, and there could be additional taxes for either one of the spouses that's receiving that money. It is a strategy, especially with a bond, but we need to look at all the factors and all the needs for that specific client.
So I think in that kind of situation, Errol, you've got to look at the structure of the contract, because that's quite important. And if you look at a life insurance policy, the contracting party is in fact the owner of that policy. So the owner is the person that would be entitled to any benefits that this policy might yield. And if there are two lives assured, then the second life assured, let's assume that that is the wife, and the first life assured is the husband. And let's assume that the husband is also the owner on this policy. And this policy caters not only for life cover events, but also for dread disease events. And like Neil was saying, possibly income protection. So what would happen in the event of the wife suffering a dread disease or getting some sort of a disability that would yield a disability income benefit payout? Those benefits are not payable to the life assured, which is the wife. Those benefits are payable to the owner of the policy. So you must be very specific on why you need those specific benefits on a joint life policy. Now, Errol, the example that you mentioned of a joint life policy to pay off a bond, that is the perfect reason why you would use a joint life policy, because in the event of a death of either the husband or the wife, or perhaps even a disability, capital disability benefit payout in the event of either the husband or the wife being disabled, that the bond is settled, yes, then that's the perfect situation. And what you could do is then cede that policy collaterally to the financial institution so that that bond is settled immediately. The benefit's not payable to the estate in any way. And that's how you fulfill your intention from a financial planning perspective.
Absolutely, that makes sense. That was my thought as well. Here, a question maybe to both of you. So let's see, how many reasons can you think of why a person should take out life cover based on your experiences? Maybe, Faeeza, you can mention one that you can think of.
I think definitely from an expense perspective, if you have expenses in your estate that might need to be paid off, a great way to fund those expenses is by using a life insurance policy. And those expenses could be, for example, your car finance or your mortgage bond or your credit card or your estate duty, your executor's fees. You know, it could be that you want to settle those expenses upon death and you use your life insurance policy to fund that.
And that would be the cheapest way. I mean,
Absolutely.
It would absolutely senseless to have debt and then have monies invested and to pay off that debt. You kill the debt first and then the remainder that provides income. And I think that's a type of strategy, what you are saying there. I don't know, Neil, any others you can think of?
Definitely to replace an income. Again, we spoke a lot about disability, but also retrenchment. We still need to earn an income, even though we have been retrenched or we have been diagnosed with a critical illness.
Okay, any others?
I think also life cover is needed to cater for any income for your dependents, you know, because they might still be minor children, or perhaps your spouse, you know, doesn't work and you need to replace your income, and then you use life insurance. In the event of your death, the life insurance pays out and your dependents can continue living the type of life that they are accustomed to.
Yeah, you know what, I can think of many strategies. Let's say that you want to take up life cover because to provide that income need. So, and you can't afford so much. Then you can start using strategies. You know what, the kids will be out of the home in 5 years' time. If I have X amount of life cover, and when the kids are out, the mommy is still young, she would have a capital amount to start that business because she's got the time available and generate her own income instead of taking life cover to the maximum. That could be a typical strategy that one can discuss with a financial planner. With others, give opportunities and make it possible. Okay, I've got, I think, about 2 more questions, more or less. Is it possible that I can insure the life of my spouse? And is there any reason for doing so?
Yes, you can definitely insure the life of your spouse. There is insurable interest there. You are, as spouses, you're both dependent on one another. And as a result, you can take out life insurance on the life of your spouse and be the owner of that policy.
Absolutely. Let's get, I think, to the last question, the last one there. So I often hear this. What you've said, if it's possible that someone can be the owner and someone else can be the life insured, will it make sense from a business perspective to insure a business partner so that I have capital available in order to buy his share of the business?
Absolutely, Errol. That's called a buy and sell contract. It's where the contract says, well, in the event of one of the business partners passing away, the surviving business partner is under an obligation to buy the shares of that deceased business partner. And as a result, it will give that survivor insurable interest to take out a life insurance policy on his business partner's life so that he has the funds available to fulfill the obligation in terms of the contract should his business partner pass away.
If I hear you correctly, technically, if I would take out life cover on your life, I'm the owner in order to purchase your shares, then that premium I'm paying is actually an investment.
Absolutely.
And that also solves the problem that the surviving spouse who's left behind with the children, she needs capital. She doesn't want to be involved with the business, so that satisfies their needs as well.
Yeah.
That makes sense.
That comes into your estate plan.
Well, thanks a lot. Well, Neil and Faeeza, thanks a lot for your time. There are no more questions, and thanks for joining me today. And I hand you over to Katiwa.
Thank you very much, ladies and gentlemen. very informative. For those of you who want to carry on this conversation with the financial advisor or financial planner, please do step into any Standard Bank branch. You should be able to get yourself someone who can help you with that. If not, if you're at home and you want someone to call you, you can SMS the word guide to the number 31791. SMS the word guide to 31791, and a financial advisor, financial planner will be in touch with you. Or you can email SBFC Voice and Digital at standardbank.co.za. That's SBFC Voice and Digital at standardbank.co.za. Thank you very much for joining us, and we will see you on the next session. Goodbye.